Good afternoon, everyone, and welcome to the Monday Open. My name is Mark. I'm one of the senior relationship managers here at Vantage Markets Australia. I'm based in Melbourne. I also have my colleague up there in Sydney. How you going, Jeff?
I'm good, Mark. How you doing, mate?
I'm good, mate. I'm good. So we do host the Monday Opens. So pretty much every Monday at 3:30. So me and Jeff, we host them. We usually do cover what's happened last week, what's upcoming this week, a bit of technical analysis, and a bit of Q&A at the end. So I'll pass it over to Jeff to kickstart off and cover what's happened last week.
Absolutely, no worries. Let me move this. So last week was all about the US jobs report. We had the ADP numbers and the JOLTS numbers during the week. They're private sector, um, readings of the US jobs market. Historically, they weren't great in terms of leading for the non-farm payrolls or the official numbers. But the last couple of years, they've gotten really quite good. Um, Maybe that means that the US government is sharing their information a little bit better with the private sector. But regardless, the headline number was that the US non farm payrolls saw the employment change and hourly earnings print better than expected, which means people are earning more money. There's the hourly earnings, and that's, inflationary, but it's also positive. And the employment change showed that there were more people employed than was expected, and that was the prior month. The downer on the employment report was that the unemployment rate rose from 4.1 to 4.2. Um, that rise in unemployment, market people normally call that seasonal stuff, but what that means is that there was a change in the participation rate. So the amount of people who are actually classified as unemployment is in different countries is deemed in different ways. In the States, it's deemed by people who are claiming unemployment benefits. So it's a ratio of the number of people who are claiming unemployment benefits based versus the number of people who are actually earning income. So that's how unemployment is based. Here in Australia, it's a little bit different than that. We strip out a lot of people who are unemployed from our numbers for whatever reason that makes the government look better than what it really is doing. But in the States, that's pretty much how they do it. They take the number of people who are claiming unemployment benefits and the number of people who are actually employed. And while we
We did
were
see a firmer US dollar, Jeff, out of that actually.
well, so I mean,
Didn't
two
happen
out of
straight away. We took a
like Meatloaf said, 2 out of 3 ain't bad, right? So I mean, two parts of the report were good. Um,
exactly.
the other part of the report wasn't. I think there were some revisions in there as well. So I mean, normally when there are revisions, uh, markets kind of take that with a grain of salt. My view is that the younger people on the bank desks these days don't actually understand what the revisions are, but that's just me. That was last week. On Mark will confirm my cynicism. So that was last week. I think where would the US dollar was broadly firmer over the week? Would you say?
Yeah, I mean, initially sort of weakened, but then it sort of caught up and ended up finishing stronger at the end of the session. I think it took the markets time to sort of digest that information,
Yeah, fair enough.
especially because
That's,
unemployment rose at 4.2%.
yeah, still good though. It's been a lot worse. All right, so that was last week. This week is mainly about interest rate decisions. So we've got the RBA in Australia announcing on Tuesday. The market is still broadly expecting no change on that one. The big four banks are still expecting the first move from the RBA to be a cut in February. They don't meet in January. But I think we might find that some of them, at least one of them, or maybe two of them, are going to start to push that out a little bit. Michelle Bullock hasn't exactly been very bullish on rate cuts, so it's not like she's preparing the market for cuts. We'll see. We'll see what eventuates out of that this week and then into early next year. On Wednesday, we've got the US CPI number. That's expected to come in plus 0.3 on the month. That is, I think, unchanged from the month before. It doesn't sound like much, but if you add up 0.3 every month for 12 months, it certainly adds up to a decent, significant number of inflation. I think what will happen is that if the US inflation is much weaker than that, We might see a little bit of dollar selling. If it comes in as expected, it's probably just going to be treated by the market as a bit of a yawn. And I can't see it coming too much higher than expected.
I think if it ticks higher, like 0.4, 0.5, we could see a strong dollar rally, and that will decrease the likelihood of the Fed actually cutting rates. It's sitting on 85% at the moment. I'd expect it on the 19th of December, but I think that will come down if we do see an uptick in CPI. What do you think, Jeff?
I think with oil prices having come off in the last couple of months, there is very close to zero chance of it being higher than expected.
Fair enough.
Well, that's the biggest input to CPI that's variable, right? So the biggest input is the price of oil. I think in the States in particular, petrol prices is the second biggest household expense after mortgage and rent payments. A lot of people have their own businesses and they drive around, and their cost of actual petrol is actually a huge cost to the inputs to virtually everything everywhere, but especially in the States. So I would say the chances of it being higher than that 0.3 are about 10 to 15% at best. On Wednesday, we've got the Canadian rate decision, and I think, Mark and I be in consensus in that Canada has been very good at flagging what they're doing with interest rates over the last 6 months. This will be, I think, the market's expecting a 50 basis point cut, and I think this will be the third consecutive one. Last month, the market was so happy that they flagged it and that it came in at 50 basis points that the Canadian dollar also actually firmed. So normally when there's a rate cut, that currency weakens just because of interest rate differentials, but it actually firmed the last time. Go on.
I think it depends on what the central bank says afterwards. So if they cut rates by 50 basis points, that's sort of already baked in the price. At the moment, if they sort of come out and say there's further room to cut rates, maybe 2 or 3 times, you'll most likely see the Canadian dollar weaken on the back of that.
Well, they can't keep doing 50. I think they're at just over 2 now, right?
Yeah.
So, I mean, if they keep doing 50, they're going to be negative, and no one really wants to do that.
I mean, the benchmark for all central banks are 2.5, 3%. Maybe that's where they sort of stop about around there.
Generally, right? So, I mean, the Swiss central bank is much lower than that. Swiss rates are generally somewhere between 1% and 2%, and have been since World War II. I guess, Western world, so we're talking about Canada, Australia, New Zealand, and the US and the UK. Yeah, we're kind of around that more like 3%. Remember, the last time that it came down really quite low was in the middle of COVID, and honestly, it won't happen again.
Yeah.
So, God, let's hope COVID doesn't happen again. Moving on to Thursday, that's the Australian employment report. The market is expecting that to firm slightly to 26,000. What that actually means is 26,000 new people or new jobs created. Doesn't sound like much, but remember, we're running a population of 30 million people. I think so. That will be the November number. I'm a pretty big believer that Decembers are always really quite good for employment in the Western world because of those seasonal employments. People that work in retail that get those December, January jobs normally support the market. Out here, we do split out full-time from part-time, but they both combine together for the actual employment report. So if you're a part-time person, I think if you're working more than 5 hours a week, you're classified as employed. Thank you very much for that. All right, cool. So I think that's the focus for this week. Just before we move on, we had a Reuters report over the weekend that said that the Chinese central bank had started buying gold again. In 2023, China was the biggest buyer of gold on the planet. And this year they've been actually really quite quiet. The talk was that they were waiting for it to fall back to that 2,400 area. It looks like they're not going to do that because last month they actually added some holdings of their gold. So if they're going to come back, they're probably going to come back as a big buyer. The rumor out of China, and obviously their officials never really confirm anything, but the rumor out of China is that they're trying to diversify out of their US dollar holdings into gold and into euro. So that could pressure the dollar and could certainly support gold. All right, Mark, did you want to talk about technicals?
Sure. Let me share my screen quickly. So we'll be going through AUD, USD, USD CAD, and gold today. So we'll start off with the Aussie dollar. We'll jump to the daily chart. Yeah, it's you can see here ever since the GDP results were released last week at 0.2%. The expected was 0.5, but they actually came out at 0.3% actually. We did see a sell-off ever since. We have come to a area here where there's been significant support in the past. You can see this area here. It might not hold. You never know. I mean, if it does hold, if you sort of see like a bullish engulfing candle here somewhere, you could see a bit of consolidation into sort of these levels here around 65 cents roughly. But this all depends on the employment data that comes out later during the week, and also what the RBA does in terms of cutting rates. Most likely they're going to hold rates, but it depends on what they come out and say afterwards. That's going to have a big impact on the Aussie. If they, yeah, I mean, if they come out so dovish, then you could sort of see this sort of sell off into the 62 area, or potentially even these levels here, 62. We could potentially get here, but that's a bit far. What do you think, Jeff? You still thinking 50 cents?
I look at that chart and it makes me feel good about the fact that in the market we call the Aussie dollar the Pacific peso. Honestly, I'm in the camp for 50 cents by Easter next year.
Yeah. I mean, yeah, it's a clear downtrend. You've seen the EMAs here reacting as well. If you look at the 4-hour chart here, yeah, just too many sellers. But as I said, this area will sort of come into place soon, so you might sort of see a bit of profit taking here. Naturally, with these sort of areas, you do tend to see some profit taking, which you might see sort of a bit of a bounce, probably a short-term bounce, and then probably continuing in the downtrend.
So I think
that's the Aussie dollar.
If I can just jump in for a
Yep.
second, I think what's going to happen
Sure,
here is that the interest rate differentials are going to become important, but it's going to be the timing factor. So the US has already started to cut rates. We haven't. We're going to have to at some stage. We're going to get to the stage where the US has finished cutting rates and the market is comfortable with their level of interest rates, and then we're going to have to continue to keep cutting because we're a little bit slow with it. You'll start to see in the press phrases like the RBA is behind the curve. That's exactly what that means. So then if the US has gone to a neutral posture and we keep cutting rates, that's where that 5 handle comes in for the Aussie.
Yeah, interesting. That's pretty much like, I mean, COVID levels. That's where we last saw this was the COVID sell-off.
Well, inflation's just as bad, right?
Yeah. Anyways, we'll move on to the USD CAD. So with the USD CAD, we've seen consolidation here. We've recently broken out on the 15th of November. We've had a retest of this area here, and then we continue to the upside. You probably see that more clearly on the weekly chart. There we go. Yeah, so you see that more clearly. So break, retest, and then continue in a direction. This move is primarily, it's a classic example of the interest rate differentials between Canada and the US. So Canada is aggressively cutting at the moment. They expected to cut by 50 basis points later this week. They're probably going to come out dovish and say there's further rate cuts down the horizon, which will further weaken the Canadian dollar and increase the US dollar here. So yeah, I mean, like if this does keep going, you could see these levels play out. It is a bit far, but within the next month or two, you could sort of see it test these levels here. In terms of a shorter term time horizon, if you look at the 4-hour chart, we did see a lot of buying here. This was on Friday after the non-farm payrolls data came out. we did see a lot of aggressive buying here. So, I mean, if you were to sort of see a pullback here, you might see it down to the EMAs here, the 50 and the 20. We can also draw a Fibonacci retracement from this low here to this high. You see also to see the 50% level in there. Yeah, but that's a big if it pulls back, because this looks very strong at the moment. But yeah, if it does pull back, you potentially could get some better entries for all if you were long on this. We do have a trend line here as well. Yeah, so what's going to be big is excuse me. What's going to be big is the when Canada cut interest rates, what they say afterwards. So if they say something like, "Oh, that's all, we're not going to cut rates any longer, it's going to stay here," for example, you could sort of see a sell off in the Canadian dollar. Yeah, but we'll have to see what happens. Anyways, let's jump to
What's your
gold
upside
now.
target?
1 second, Jeff. Okay, we go back to it. Upside target is. I have to jump on a weekly for this. Okay, so upside target. So we've seen these levels here come into play. I mean, this is 2016. This is 2020. But that's the longer term, sort of 2 to 3 months sort of target. So it might sort of like
600
pull
points.
back, make you. I mean, yeah, 2 to 3 months. That's a while away. You could sort of see like a pullback into this area, consolidate, and then sort of break out again. But if everything goes well, yeah, these could come into play.
Not well for Canada, obviously.
Yeah, no, not well. Yeah, don't forget oil prices as well. If oil prices go down, that weighs on the Canadian dollar.
Mate, to get up to those levels, oil's going to have to fall to 60 cents.
Yeah, I mean, it could just be purely the Fed. I mean, like holding rates, and Canada keep cutting rates.
Yeah.
Yeah, I mean, coming into the holiday season, you might sort of see a little bit less volatility. So you could even sort of see a bit of chopping around before sort of it takes off again, maybe in January. But yeah, it all depends on the central banks and what they say. Anyways, we'll move on to gold now. So gold has been very interesting the last week and a half since 26th of November. There's been nothing going on, just choppy sideways price action. You can see here more clearly on the 4-hour chart. So yeah, if this was to break to the downside, ideally breaking this level here, you could see this support level come into play between 25.61 and 25.36. If it does break to the upside, you could see 27.21, 27.05 come into play. So yeah, I mean, it is sort of the EMA. What's interesting is the EMA here is acting as resistance at the moment. So yeah, I mean, it's doing nothing. We just have to sort of wait and see which way it decides to break. We did actually get a gap this morning. You can see here a gap this morning. I believe that was due to there was a Reuters article saying that China. What was it again, Jeff? China. What did they do? They bought up gold in more than expected in November.
No, they started buying gold again. So they haven't bought any gold at all this year. They were massive buyers last year, and they've just started dipping their toes back in the water last month. So you watch those for the price of gold. I mean, China, and I mean India as well. Historically, the year before last, India was the biggest buyer of gold. So you look at those two countries, and you look at there'll always be an article somewhere on Reuters, or Forex Live normally reports them as well. You really do want to keep an eye on what the central banks are doing. I think something like 80% of all of the volume in gold is central bank buying and selling.
Interesting, yeah. So again, with gold, like as we sort of get closer to January, where Trump comes in, the market are expecting sort of geopolitical tensions to ease off. So that could put downward pressure on gold as well. So if you look at sort of the weekly chart, this could sort of be the sort of a bigger move to the downside, potentially even to these levels here. but it may not happen until sort of January. But if something does come out in the meantime and surprise the markets, then you'll probably see a rally in gold because it does act as a safe haven in times of uncertainty. Anyways, that's enough for gold. We'll stop with the technicals now, and we'll move on to the question and answers. I'll pass it over to you, Jeff.
All right, cool. So the concept of this little section is that Mark and I are talking to people on the phone all week long, and occasionally we get a question from someone, and it's, I don't want to say a good one, but it's an interesting one that we feel that we'd like to share with a broader audience. So we try and do 2 of them every week. Question 1, Mark, did you want to do with that one, mate?
Yeah, sure. So what trading session offers the most volatility? Well, it's the US session offers the most volatility, but the way the sessions are sort of broken up is you have the Asia session, which starts in the morning, 10 o'clock a.m. Australian Eastern Standard Time, and then you got the London session, which comes in later in the evening, about 7 p.m., and then you sort of get the US session starting at about 12 a.m. So really, the most time with the highest volatility is when London actually crosses over into the US session. So both sessions are actually active, and that's primarily from 12 a.m. to about 3 p.m. Until London goes offline at about 4 o'clock in the morning. But usually from 12 a.m. to 3 is when you typically see the most movements. I'm not saying there's no opportunities before that, but you typically see the biggest move between those sessions.
Okay, and that's just for everyone. That's Eastern Standard Time. Generally, that's because the US data is the biggest mover in markets, and obviously the US releases their data during their time zone. Question number 2, tell me about volume analysis on Forex. I get this one all the time. Forex is the biggest market in the world. We all know that. I think it's like $7 trillion worth of Forex is transacted every day. Of that number, something like 60% of it is interbank trading, which is mainly corporate stuff. There's a little bit of trading as well and price making, but most of it's corporate stuff. When you're looking at from a retail, so the retail perspective is less than 5% of all of the volume in Forex trading. When you're looking at volume analysis on your TradingView or on your MetaQuotes platform, what you're seeing from your broker is broker volume. So if you're with us, you'll see the volume that's traded on Vantage's platform. It's not holistic, it's not big, and the reason it isn't holistic or big is because Forex is an OTC market, an over-the-counter market, and there are no accurate volume numbers anywhere. If you really wanted to do volume analysis, I would suggest looking at the volume on the futures contracts that are traded on the CBOT. If you kind of wanted to do a daily thing, they release those, I think, an hour or 2 hours after the close every day. If you're looking for volume spikes to confirm a move on a daily or weekly basis, that's probably the best way to go. But don't try and do unbalanced volume and stuff on short-term periods on currencies. So that's it for the Q&A. While we've got you here, obviously, this video is live on our VIP trading room. Once it's concluded, it'll also be uploaded live to our YouTube channel. That trading room, if you haven't visited, is something that you really should. Mark and I are logged into that all day long. You can ask questions, have conversations with us if you're more a typer than a talker. We also have some analysts from the Everest Fortune Group that are in there. They can answer some questions as well, and they provide a little bit of analysis too. We also do, in terms of content, a weekly technical video that is uploaded every Friday morning, hopefully when we get it on time. And we also have our daily private client daily update, which Mark and I write every morning, and we email out every morning before 10:30 Eastern Standard Time again. If you guys want to be added to that mailing list, please don't hesitate to reach out. You can send us a note through the trading room, give us a call, or send us an email. We can add you to that without any problems at all. Just before we finish up, some housekeeping. This is the second last one of these for this year. Our office will be closing for a couple of weeks over Christmas. So we will have this next week or next Monday at the same time, and that will be the last one for the year. And we will be back on the 20th of January. So if we don't get a chance to speak to you, Merry Christmas or Happy Holidays or Happy Break or whatever it is that you call it. And we shall talk to you again soon. Thank you very much. See you, mate.